It's Thursday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming up we're going to have Mike Baudendistel giving us a rail intermodal update. But first, we're going to go to Zach Strickland with the carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your carrier update presented by PowerFleet. I am Zach Strickland, and today we've got a system moving through the southeastern corner of the United States. But what is that doing to the overall capacity of the market? Let's check it out. So I've got behind me here charts of the van outbound tender rejection index along with the reefer outbound tender rejection index for the United States. You can see that the reefer situation continues to stabilize across the country in general on average. You'll probably have a few isolated spots of disruption as we've seen in the Midwest here over the last few weeks. But van tender rejection rates starting to peak up a little bit. If you look all the way down here, you'll see that green sign down there on the bottom of our sonar chart. 5.49% in green means that we've had an uptick, about a 18 basis point jump day over day. That is a pretty good sign for things to come, especially in February. We don't really expect a lot of that movement. You can see that we've been relatively flat since we started the month of February, a slight degradation before upticking a little bit here over the last week or so. Some of the markets that are important to watch in terms of tightening capacity or increasing rejection rates: Mobile, Alabama, Duluth, Minnesota, Grand Junction, Colorado, Minneapolis, Minnesota, all showing significant increases in rejection rates versus last week. We're going to pull that back to see. Out here, the tweener rejections tend to be the highest rejected ones out in the market, 6.94% for the mid-haul rejection. So again, a little bit of tightness in some of the length of hauls, but nothing to get too excited about just yet. We still are in February. So looking at the weighted rejection index map, you can see some of those markets we were talking about down here covered up in rain. The Mobile market, Denver, Colorado, Minneapolis, Minnesota, and up here around Harrisburg, Pennsylvania, some isolated spots of tightness showing up. But you see this big green blob with a little bit of blue right here. That's about 6 hours into the future when we expect this system to push on through the southeast and create a little bit of travel hazards, a little bit of disruption. I know North Carolina, not necessarily a huge market for freight, tends to be a little bit more backhaul, a little bit more consumption oriented because of Charlotte. Big population center there, not a lot of production. The northern part of North Carolina tends to have a little bit more freight in it, some of those rural outlying areas, etc. So we're not necessarily seeing anything just yet. The system is supposed to drop a few inches of snow, which of course in the southeast means that everybody's going to go buy bread and milk and also get off the roads, hopefully, because they can't traverse them as easily as they can in other parts of the country where they are more prepared for them. So what that means for us, inbound tender rejection rates have jumped up a little bit going into the North Carolina state. So behind me here, inbound tender rejection rates jumping up about 22 basis points day over day, but they are kind of trending up anyway. Whether or not that's related to the storm, it's hard to tell, but it is a high enough, versus the end of January. It's the highest point we've seen inbound tender rejection rates since the end of January. So there is something to it, not necessarily everything. Let's check out the rest of the southeast. Atlanta, Georgia. I wanted to pull this one up because you see the reefer volumes or the reefer rejection rates down here. They're kind of volatile, jumping up and down. They're on their way down, but van rejection rates jumping up pretty significantly day over day, about 62 basis points. So they're around 2.6% yesterday, 3.2% today. That means that you are going to have, it's something to watch here in the future. It doesn't mean you're going to see a flood of action on the spot market, but you should see some increasing activity here. Probably bouncing down to their second or third options on their route guides. The shippers are here in the last little bit. Some of the length of hauls, mid-haul rejection rates leading the way, short haul next. So a lot of regional movement probably available on the spot market, not necessarily a huge amount of margin available on those, however. So looking at our last market, Mobile, Alabama, shooting up to 13.13% on the tender rejection rate. Van rejection rates up around 20%. For sure, check out the Mobile market for spot market activity, and that'll do it for today's carrier update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Welcome to this Rail and Intermodal update. I'm here with Mike Baudendistel. Mr. B, what do you have for us today?
So this week, a couple of rail car companies reported earnings. First, Wabtec Corporation, they make all manner of components that go into rail cars, locomotives, really all over the world. And they're the biggest locomotive manufacturer since they acquired GE Transportation. Also, Trinity Industries reported they're the biggest rail car manufacturer in North America. And a couple of industry trends I think were really highlighted. I mean, maybe not surprising, but the number of locomotives built this year, Wabtec says those will be down at least 10%. They didn't put a lower bound on it. It could be much worse than down 10%. And on the rail car side, they're expecting about 40,000 units being manufactured. That's down from 58,000 last year. So a big percentage drop, but I really don't think 40,000 is that terrible, considering that it's roughly, or at least close to, replacement demand for North American rail cars. You figure 1.6 million rail cars in North America, 40-year average life. That gets you to 40,000 a year, maybe gets to 45,000 with some obsolescence and those type of things. And really, Sonar expands upon those things and shows a couple of kind of unique data series. This is one that's rail car storage prices, and you can just see how much rail car storage prices have shot up since November. And this is a per day rate, so you see it going from just a couple of dollars a day to, in the upper Midwest, almost $14. Currently you've seen more volatility in the central states, but would expect maybe that to shoot up again soon. So it's more getting more expensive to store rail cars. It shows there's basically a lack of storage in certain places, and you don't want to store those cars in the upper Midwest if you can avoid it. This chart really expands upon why, and this is not a Sonar chart, it's from the AAR. This is the rail cars in storage that have been in storage for a certain number of days. But you can just see throughout 2019, every month, the number of rail cars in storage increased by something like 15,000 units on average. So it really expanded. So this is the most cars we've had in storage since 2016, with about almost exactly 400,000 units being stored. That's 24% of the North American fleet. And really, it's widespread across the various rail car types. Every rail car type has at least 10% excess of the major types, but most are over 20%. So it's a good time to be able to source those rail cars if you need to do that. This next Sonar chart expands upon some of these things and shows leasing rates, which is a fairly unique series. There's not much out there publicly about rail car leasing. We're expecting these to come down. You see tank cars being higher. These are really depressed rates for covered hoppers and gondolas. Of course, gondolas are traditionally one of the coal car movers of coal cars. And one of the interesting data points recently on this was GATX has this lease price index where they talk about what they expect lease rates to do versus the lease rates that are expiring. Those leases are multi-year in duration. So they say this year down 10 to 20% versus those leases that were last priced, say, 4 to 6 years ago, that would be expiring, this year. So that's a good news for shipper, not a great news for leasing companies. Also heard from Trinity Industries, who reported last night their orders were pretty dismal. They had about 2,500 units ordered in the fourth quarter. These are for newly manufactured rail cars, and they also had cancellations of about 500 units. So only a couple thousand units, and this is for a company that manufactured over 6,000 units in that quarter. So very low sort of book to bill, and so there's not a lot of demand for new rail cars. Good time to be a shipper, not a great time to be a leasing company.
Gotcha. A lot less demand, especially when we're comparing similar to 2016. Mike, thank you so much for that insight. Tied it together wonderfully. And thank you so much for tuning in. That's going to do for this rail, intermodal, and equipment update. And that's going to do for also this edition of FreightWaves Now. Thank you so much for tuning in. We're always streaming around the clock on our FreightWaves TV app, so check us out there. And also, if you're looking for some deeper insights, check out our Passport program, where you get access to all of our really deep research teams, projects, and access to all of our world-class events. Thank you so much for tuning in, and we'll see you on the next episode.
Is the trade war back on?
Trade war.
Trade war, full-blown trade war.
15% tariffs on $112 billion worth of goods.
Hours earlier, China announced tariffs of 5% and 10% on U.S. products.